Hello everyone, my name is Anita and I'm the Senior Vice President here at Calamos Wealth Management. Today I'm joined by our Chief Investment Officer Michael Kassab, who will share his insights on recent headlines. Hello Mike.
Hi Anita.
Well, it's certainly been an eventful start to the year. We have a new president in the White House, and with that comes a higher level of policy uncertainty as it relates to taxes or healthcare or trade. Yet at the same time, the stock market finds itself at all-time highs. But before we dive into the markets, I'd like to get your views on the U.S. economy. How would you characterize the current backdrop?
I would characterize it as pretty good, and generally I believe we're headed in the right direction. You know, we've averaged just about 2% GDP growth for the past 7 years, and the question now is whether we can head back towards the 3% growth that we experienced from 1990 really up until 2007. The president believes we can get there through some fiscal policy initiatives, such as tax reform, deregulation, infrastructure spending. We've heard him campaign on those throughout the fall. And you can see the optimism was really reflected in data such as small business confidence and consumer sentiment, which have each reached 10-year highs post-election. But there really hasn't been a corresponding jump in some more concrete measures of economic growth, such as retail sales and wage growth. This gap between soft and hard data has garnered quite a bit of attention, but we think it's really too early to expect any evidence of a big pickup in growth.
Mike, in our industry, when we talk about market cycles, we tend to talk about innings of a baseball game. Using that analogy, where do you think we are?
We spent most of last year saying that we were likely in the later innings of the game, but we cautioned then that sometimes those final few innings can last a long time. Truth is, if Congress passes some pro-growth policies, we may actually return to the middle innings, maybe even in the early innings. Time will tell on that front. But with or without those policies, we believe the economic cycle has at least a couple more years of expansion ahead.
Mike, you just spoke about expansion, yet the first quarter GDP was a disappointing 0.7%. Does that statistic concern you at all?
Well, it definitely was a weak number, but we need to keep in mind that this is now the third time in the past 4 years that the first quarter came in weak. That doesn't mean we should disregard it, but we have to assume at least some of the weakness was due to quirks in the seasonal adjustment factors. But when you dig past the headline number, there are actually some encouraging signs. There was a nice pickup in business spending, which has languished for the last couple of years. And since that GDP release came out, we had a very solid April jobs number. The U.S. added another 211,000 jobs, and the unemployment rate ticked down even further to 4.4%. So I think it's important to take that GDP number in its full context.
And it's probably worth noting, too, that for the first quarter, corporate earnings were fairly strong, correct?
No, that's right. By now, most companies in the S&P 500 reported their numbers, and the quarter is shaping up to be a terrific one. We're on pace to grow about 13.5% versus a year ago. And that's actually the quickest pace in nearly 6 years. The gains are pretty broad-based, too. 10 of the 11 sectors have shown positive growth. Not surprisingly, the energy sector is leading the way given the rebound in oil prices. But even if you remove energy stocks, the earnings for the rest of the S&P 500 are growing actually north of 9%, and that's a great number.
That's encouraging news. Mike, if we can just shift to taxes briefly. The Trump administration, just in the past couple of weeks, released a tax plan that, if implemented, could have a big impact on the economy. Large cuts were proposed, both for individual and corporate tax rates. What are the odds, in your opinion, that Congress passes sweeping tax changes along those lines?
Well, it's always a challenge to handicap outcomes when it comes to Washington. But I think the odds are good that we eventually get some form of tax cuts. Now, the original timeline called for August, but we don't see anything happening until most likely the end of this year, maybe even early next year. And the cuts likely won't be as aggressive as what the president outlined.
Not as aggressive. Okay, why is that?
Well, for one, nothing gets done easily in Washington given the hyper-partisan environment. We saw in the healthcare bill, it's hard to even reach consensus within one party given the different factions. And we believe passing huge tax cuts will prove even more contentious. The other reason, simply put, is the price tag. The president's plan calls for a cut in the corporate tax rate from 35% to 15%, a cut in the top individual tax rate, a doubling of the standard deduction, full repeal of the estate tax and the alternative minimum tax. and an elimination of the Obamacare surcharge.
Mike, can you elaborate further on that? How would those components that you just mentioned impact the overall budget?
Sure. To put things in context, the Congressional Budget Office projects the federal government will collect about $3.4 trillion and spend about $4 trillion in fiscal 2017. That leaves a budget deficit of almost $600 billion for this year alone, and the deficits are only scheduled to grow over the next decade based on current laws. So the tax debate will likely boil down to whether the plan adds further to the national debt or if somehow it could be revenue neutral. The math is pretty simple. When you cut tax rates, you collect less revenue. But the president's economic team would argue that tax cuts would boost economic growth, that would broaden the tax base and essentially help pay for itself. Now, that may or may not actually prove out, but without diving too far into the weeds, we believe the plan may need to be scaled back to get through Congress.
Certainly sounds more complicated than a simple headline. So what does this mean for the markets?
Well, you're right, it is complicated. But what the markets arguably care about most are the corporate tax cuts, as this would have the most direct impact on corporate earnings. Now, the good news is this is one of the areas where there is actually some bipartisan support, as many believe that the current tax rate puts U.S. firms at a disadvantage relative to global peers. That gives us confidence that a decrease in the corporate tax rate will make its way into the final package. Maybe not all the way down to 15%, but 20 or 25% seems feasible.
Let's quickly touch on interest rates. After the election, we saw rates move a little bit higher, and since then they've retreated somewhat. What's your interest rate forecast for the remainder of the year?
Well, first, it's important to distinguish between short rates and long-term rates. So with regard to short rates, we do see them moving higher, as the Fed will likely hike another 2 times this year, most likely in June and September. That's what the market's expecting. That would bring the federal funds rate from just over 0% back in December of 2015 to about 1.5% by year end. Now, as for long rates, we continue to believe they will remain relatively contained. They did initially spike post-election, but they have since retreated. Ultimately, we believe longer rates are anchored down by comparable rates of our global peers. In Japan, the 10-year yield is still hovering around 0, and in Germany, it's just north of 40 basis points.
Mike, you've given us a lot to think about. So if we put all of that together, we have an economy that appears to be on sound footing. We have strong first quarter corporate earnings. Yet we also have heightened uncertainty with regards to which of Trump's proposals become actual legislation. Putting all of that together, where do you feel equity markets go from here?
We have to start by acknowledging that, yes, the U.S. equity markets have run quite a bit in the past 6 months. The S&P is now up around 13% since the election. With that said, the index has traded within a 2 or 3% trading range for most of March and April and into May. And we expect that sideways pattern to continue. So yes, the economic backdrop, while not spectacular, has been solid, and earnings have indeed come in strong. But we think it makes sense for stocks to sort of remain in this wait-and-see mode until we get some more clarity on what a final tax bill will look like. However, we do see equities climbing higher again later in the year.
Well, thank you, Mike, for joining us and sharing your insights.